Whenever a bright person, really bright person goes broke that has a lot of money, it's because of leverage. It'd be almost impossible to go broke without borrowed money being in the equation.
That's Mr. Buffett's take. In this video, we will look at leverage in the aggregate, right? What does the widespread use of leverage today tell us about where we are within the Elliott Wave structure? Leverage has, quote, seeped into every pore of finance. That's how my colleagues Steve Hochberg and Pete Kendall described the situation last month. A good way to view it: volumes in leveraged ETFs. These are single stock ETFs, so these products amplify returns on individual stocks. Those steady volumes in 22 and 23, they began to inch higher at the start of the year, and they have pretty much gone vertical now as we enter the new year. This is a love affair between retail investors and leverage, confirmed by this Bloomberg chart of weekly traded value. 86 billion traded in single name leverage products over one single week in November. That was a new record. What this tells us is that the regular normal gains that stocks typically deliver, those are just no longer enough. It's akin to a drug where investors need double, triple the dose to get the same fix. Keep in mind as well, this is a year when the boring old S&P returned 30%. You add that to a 24% gain last year. This is only the third time in 100 years where we've seen back-to-back gains of this size. This is, in our view, a classic sentiment extreme that arises at the end of a long advance, and it's the kind of thing we study, actually. There's dozens more sentiment gauges that help us to quantify and to forecast these waves of optimism and pessimism that ultimately drive stock prices. If you want to learn more about our approach, be sure to like and subscribe. The links in the description will also take you to our full services. Thanks for watching.